The Federal Reserve decided to cut rates again today. Your reaction to the decision?
Well, this one was very much anticipated. The market was anticipating this rate cut, so it fulfills the market expectation, which is good. I think they'll be taking a very close look at the minutes when they come out to see kind of what that says about what future rate cuts may look at. But this one was largely anticipated. It will lower probably certainly some rates will be lowered. I think it will help put a little more downward pressure on mortgage rates, which will help the housing market. So on the whole, again, not a lot of surprise here at all, and I think it will have some effects towards helping to stimulate things a bit.
What do you think it indicates for the economy?
Well, it indicates that the Federal Reserve is worried about the job market right now, and they're trying to do some things to sort of help stopgap that to some extent. We've seen weakness in the labor market. We've been handicapped to some extent because of all the lags in data since the shutdown. But nonetheless, all the secondary data we're seeing is confirming that the labor market is pretty weak right now. College graduates coming out this year having a rough time, it seems like, and people are saying this will not be a very good job market for them. I think all of that's weighing in on the decision right now and just trying to provide a little more backstop for the labor market.
You mentioned the housing market. If someone, say in East Texas is on the fence right now about wanting to get a home, could now be the time to do so with these rates going down?
Well, we have seen mortgage rates come down some. They're not necessarily tied to this rate. This is an overnight rate. They're not necessarily tied to this. Last year, when the Federal Reserve lowered rates, mortgage rates actually went up because it's more of a supply and demand kind of situation once you get that far removed from the Fed rate. But lately, the mortgage rate has been tracking, has been falling. So this is probably a pretty good time to be looking. We still have the issue of insurance rates being very high at this point in time, but we're seeing some softness in prices. Houses are staying on the market longer right now. So there's some reasons why this is probably not a bad time to be looking.
How could you see this interest rate overall, this interest rate cut impacting those in East Texas?
Well, I think the primary thing is that there are a lot of interest rates that are tied to this. Even though it's an overnight rate, the bank prime rate is tied to it. So interest rates at banks overnight immediately will drop by a quarter. A lot of local businesses will have loans that are based on prime +1 or something like that. Some formula tied to prime. Prime's tied to this rate, so those rates will drop immediately. A lot of credit card rates are tied to prime or tied to the Fed to prime, which is in turn tied to the Fed rate. So those rates will drop immediately. So you will see some benefits to people in East Texas and elsewhere of having these rates continue to decline. I think the primary thing the market's going to be looking at is what does this say about the future? And there's already hints that this may be the last one for a while. Some of the European and Asian central banks are pausing their rate decreases right now. So we'll have to see how this plays out going forward.
You mentioned credit cards. For those, what real impact do you think this could mean for those looking, that have credit cards?
Well, basically, it means that for a lot of credit cards, not all of them, but a lot of credit cards have their rate tied to a formula that essentially includes this. So the rate's going to go down by 0.5% or 1/4%. I'm sorry, and that makes a difference when you start compounding it over time. Might stimulate a few people to spend a little more money at Christmas, knowing that the rate will be a little bit lower.
Yeah, we're talking, as the holiday season is approaching, could you see this actually making people, potentially spend a bit more on gifts or anything else they're looking for with the season approaching?
It can make a small difference. I mean, if you look at things right now, we're in one of those unusual situations where consumer confidence is pretty low. People are kind of concerned about uncertainty. The job market's kind of weak, but people seem like they're spending money during this holiday season, and a lot of that is that to some extent the holiday season kind of dances to its own drummer. People just decide they're going to do certain things during the holidays that don't necessarily track what they would do other times of the year. But thus far, what we're seeing in the early indicators, at least what happened on Black Friday, what happened on Cyber Monday, what's happened in the past couple of weeks, all suggest that this is going to be a decent shopping season.
What are some other, big purchases this could impact for folks?
Well, again, you find some things. This will lower the cost. Some auto loans are directly tied to this rate or indirectly to the prime rate. And then you'll also see it also lowers the cost to a lot of companies that may lead them to offer incentives during the holiday season on furniture, on cars, on appliances, on electronics, on some of the bigger ticket items that people tend to pay for over time. You may see some incentives for some of the manufacturers and the retailers to offer packages with lower interest rates involved that might help to stimulate some of those purchases.
You mentioned the uncertainty earlier. If someone is looking for something, like a car, for example, would you recommend like now would be the time to do it heading into the new year?
Well, I think that's an individual decision. That they need to look at their own situation. They know whether their job prospects are good or not. They know what their income's likely to be. So that's very much an individual decision. Globally, in a global perspective, the situation is a little bit better now than it was a month ago, but it was also a lot better a year ago than it is today. But that's pretty much an individual decision.
And you mentioned, what's next? What are you expecting for the Federal Reserve to do come their next meeting? It's my understanding it's in January.
Well, I think what the main thing you're going to see is we're supposed to get quite a bit of data between now and then. Some of the making up some of the backlog from the shutdown, and I think they'll be looking at that data very carefully because they're kind of in a difficult situation right now. In that inflation is still higher than they want it to be, which would indicate not raising rates, but the job market is soft, which would indicate raising rates. Gross product growth has held up fairly well in the midst of all that, which would again suggest that a pause is in order. So I think they're going to take a really close look at the data and make that determination. At this point in time, most of the commentary you're seeing from Fed governors making speeches and that sort of thing is that that this may be the last one for a while. But I think once they see the data, we'll have a better read on that.
Do you feel as though the decision was the correct one to cut interest rates by roughly a quarter? You feel it should have been larger, zero?
I think they did pretty well on this. Again, they're in a difficult situation now because usually it's fairly clear you need to stimulate the economy or you need to slow down the economy or you need to leave it alone. Right now, there's conflicting information in that. They're trying to kind of hit the Goldilocks thing and do it just right. And I think had I had a vote today, I would have voted for a quarter point rate cut.
How unique is this position, the Fed's currently in? Is there any time in recent history, maybe not even recent, where the Fed has been in a position like this in your view?
We haven't seen it quite like this for a while. Normally, we've had periods of pretty rapid inflation that were accompanying economic growth, and which is kind of what you expect to see. You really have to go back. The last time we had the so-called stagflation, that is kind of a sluggish market and inflation, was about 40 years ago, and that was much more dramatic on both counts. Much higher inflation and much more sluggish growth. So we really haven't seen a parallel to exactly this. The last time we saw it even similar to this, it was much worse and basically what we have today on steroids.